Hit it.
It's Friday, August 13th, 2021, episode 144. I'm Patrick Ceresna.
And I'm Kevin Muir. We continue on with our interview-only summer specials, and this week, David Keller joins Patrick Ceresna for a deep dive on technical analysis. They discuss breadth, sector rotation, seasonality, and end with a great discussion on security selection.
Okay, on to the interview. I have the great pleasure to be joined by David Keller, CMT and Chief Market Strategist at StockCharts.com. Dave, thanks for joining me.
Yeah, it's a pleasure, Pat. Good to talk with you again.
Yeah, and so for our listeners that weren't a Huddle listeners for a year back, it was back during the COVID crash. Actually, it was March 21st. Of 2020 that you were on the show. You were the market bottom. You were the market bottom. So nonetheless, and we had you on, and we did a great episode called Debunking Technical Analysis Misconceptions. So anybody that wants to go back and listen, we had a great history where Dave shared some of his past with us. But really, because we've already done that, we're just going to dive right into the meat of this, which is I want to talk technical analysis. We have the summer special here. We're going to, and what we really wanted to do is be diverse, give each part of the markets a little bit of exposure. In this case, we're going to focus a little bit on the technical analysis aspect of the markets. And why I really asked you to do is because I wanted to go beyond, this is a moving average, this is a trend line. I wanted to kind of take a deeper dive into technical analysis in terms of just the way that we study the markets through price. And so maybe what you can do is just gonna give us a high level review of how you come across the markets, how in terms of the way you approach the markets, and why technical analysis is a really important part of your process.
Yeah, that's all really good questions, Pat. And when I describe my process to people, I sort of, very quickly come to the concept of what I call market awareness. And this comes from aviation. I've spent time trying to learn how to fly a Cessna 172, mostly around New England. And what pilots tell you is to make sure you have good situational awareness, which is understanding what's happening inside the airplane, outside of your airplane, because some of the common accidents or common mishaps for private pilots are because of pilot error. It's a poor decision, and often because you run out of fuel or you run into an obstacle, things that could be avoidable if you just had a better situational awareness of the conditions inside and outside of your airplane. And so it's funny, with my first flight instructor, we talked a lot about the relationship between what we were doing, in aviation, and also what we were doing as investors, because he was day trading stocks when he wasn't teaching me how to fly the plane. And so, for me, my own firm, when I launched it, called Sierra Alpha Research, that all came from aviation, and Sierra Alpha is slang for situational awareness, because I found it was such an important concept for flying and also for trading and for investing. So I've always talked about technical analysis as being an ideal way to improve your own market awareness, what's happening inside your portfolio, but also what's happening outside of your portfolio. And a lot of times as investors, we sort of get the blinders on. We focus on a particular trade, a particular level, a particular investment thesis, and we miss opportunities because we're not having a consistent process of reviewing the landscape around us as investors, the investing landscape, and focusing on improving that market awareness. So for me, it starts with really it's three pieces. It's a macro strategy. It's understanding the big picture, asset allocation. Should I be in the markets or not, and where should I be allocated? Question two is sector rotation, assuming I have an exposure to equities. What are the sector themes that I need to be aware of? And then finally, security selection. Now that I have an idea of what I think is going on, how do I actually express that in a portfolio or in a particular trade? And each one of those has other sort of pieces below that, but it's making sure, I think for investors, it's making sure that you have good ways of answering those questions the macro environment, the sector rotation conditions, and and moves in individual securities, individual stocks in your universe, and making sure you have a consistent process, not just one-time thing that you're able to do, but a consistent process. What is your process of looking at things every day, every week, every month to make sure that you are updating that effectively. And I have found, working with a lot of institutional investors, financial advisors, and more individual investors, it's that charting technical analysis is an ideal way to make sense of the world around us, to focus on what's working and what isn't, and to make sure that you're allocating into the trends that are in good shape.
All right, well, let's dive right into it. And so under that macro strategy, one of the things that you focus on is the breadth of the market. And what I want to do is really, the way I always interpret it, it's like looking under the hood. Like when you look at an index, it's the price level is just what the price level is. But how are things really moving in the internals, like the pulse of the market, the blood pressure of the market? Like it's like, how are things really working underneath? And well, so first of all, why don't we just start off with explaining what the way you define breadth and what you think of it, and then let's get into some examples of some of the different indicators one could use to study it.
Sure. So I think you described market breadth beautifully. I like that analogy of taking the pulse of the market. A lot of times you get very caught up into the high level averages. What is the S&P doing, the Dow doing, the NASDAQ doing? And don't get me wrong, Ralph Akinpora, one of my mentors early in my career and to this day, often told me, if you had one thing to look at to make sense of the markets, it should just be a chart of the S&P 500. If you have nothing else, just look at the price and make sure you analyze that effectively. And I think there's a lot of wisdom in that. But breadth sort of lets you look a level below there and see not just what is the market doing overall, but what are the stocks that comprise the market actually doing? So I always describe breadth as participation, right? When the market is doing one thing, what are the stocks that comprise that market doing? What are the members of the S&P 500 doing? What are the stocks that comprise the NASDAQ 100? What are they actually doing? Because a lot of times at inflection points, especially market tops, you'll have a situation where the market does one thing and the breadth indicators will do something different. And a lot of times that can provide an early warning system that things are not necessarily right. And to be honest with you, January, February of 2020 were pretty ideal examples of that, where you had breadth divergences. You had the market moving higher into February, but the breadth indicators actually rolling over, which told you that it was not overall as healthy a market as the price of the S&P might have said.
Right. And so let's dive into some of these indicators. Like which one do you think is your core one? Which one is it that you want to start with?
Yeah, so for me, you can think about breadth in a number of different ways. And the way that I usually start with is looking at what are called cumulative advanced decline lines. And every day on a broad market like the New York Stock Exchange, on a particular index like the S&P 500, you can come up with a daily advancers decliners value. And that's literally the number of stocks that closed up on the day minus the number of stocks that closed down on the day. And it's called the cumulative advanced decline line because you basically keep a running total of that daily difference between advancers decliners. And over time, you have a cumulative measure of how many stocks are closing up or down over time. And it would make sense that if the market overall is going higher, if the S&P is going higher, it would stand to reason that more stocks are probably closing up than closing down, because that's what allows the index to go higher. And the chart that I have on the screen right now sort of demonstrates that. You have the S&P 500 at the top on a closing basis in an uptrend, obviously, over the last 12 months, fairly consistently. The second panel down is called the S&P Advanced Decline Line. So that's looking at the 500 S&P members and taking a running total of advancers minus decliners. And overall, you can see that also is in a fairly consistent uptrend over the last year. So overall, thumbs up, this makes sense. New highs in the market. There are more stocks closing higher than lower. But look at some of the other series that I'm showing on here, and you can see that all the other ones are actually making a lower high right now. So the one just above that is called the NYSE, the New York Stock Exchange Common Stock Only Advanced Decline Line. So in the entire New York Stock Exchange, they're actually, this is actually turning down. So the advancers decliners are not confirming the most recent high in the S&P. The same for the mid cap index, which is the next one, next from the bottom. And the very last one is the small cap index, which is actually breaking below its 50-day moving average. So what's happening here is you have the S&P 500 moving higher, but these measures of participation, these measures of breadth are actually sloping downwards. So what's going on there? It's actually about leadership rotation. All the cyclical stocks, things like energy, financials, industrials, materials that had been in pretty strong uptrends are all starting to roll over a little bit, have started to break down a little bit, breaking down through some support levels. And as a result, especially in the mid cap and small cap space, they're not showing as healthy of a trend measure or as a breadth measure as the S&P 500. So that's one of those early warning signs that could actually be signaling right now. We saw a very similar thing again at the market top in January, February of 2020.
Now, David, what we just need to let our listeners know, we were recording this here in the first week of July. And so many of you are listening this to a month or more later. And so when we're referencing to where the markets currently are, this is recorded in that first week of July. All right. So I do really like these advanced decline lines. They do give us great information on that. Where do you go next usually when you're looking at breadth?
So step two for me would be looking at percents of stocks above their 200 and their 50-day moving averages. So what this is doing is it's looking at the S&P 500 as a group of 500 stocks, and it's showing you, the S&P 500 or any data series. You can smooth out the price data looking at the moving averages, and I'm sure your listeners are probably familiar with things like the 50 and 200-day moving averages. Just very simple ways of smoothing out the noise of day-to-day price movements and understanding the larger trend. And a common way we think about something like the 50-day moving averages is if the price is above the 50-day moving average, overall, the short-term trend is fairly positive because it's above today, it's above its sort of average price over a look-back period. And when it goes below its 50-day moving average, often that's a sign of weakness, because it's going below that average price for the last 50 days. We can roll that sort of analysis up into a breadth indicator. So the second panel down is in blue is the percent of stocks in the S&P 500 that are above their own 200-day moving averages. And then the bottom panel in green is the percent of stocks above their 50-day moving average. And again, in early July, as we're recording this, it's right around 50%. So if you think about what's happened in the first half of the year, you can see why this breadth indicator was very encouraging in the first half of the first 4 or 5 months of the year. And now all of a sudden has turned a little more negative going into the summer months. And what I mean is this: if the S&P is in an uptrend and the trend is healthy and looking underneath the hood, overall conditions are good, then there should be an expanding number of stocks that are above their own 50-day moving average, because a lot of stocks in an uptrend above their own moving averages means the trend is positive and there are a lot of stocks participating in the uptrend. If you look in April of this year, it was about 92% of the S&P that were above their 50-day moving average, as the S&P made a new all-time high there in the second week in April. From there, though, it's actually gotten lower and lower. So when the S&P was actually testing its own 50-day moving average in mid-June, it was about 32% of the S&P that was still above their own 50-day moving average. So about 60% of the S&P essentially was above its moving average and all rotated below there. And now, even as the S&P is making new highs going into early July, it's still only about 50% of the S&P members that are above their 50 days. So this is a great way to sort of indicate how many stocks are participating in the current uptrend or not. And if you look at just the members of the S&P, you can see that it's only about half of the S&P stocks that are above their 50-day moving average, not just not making new highs, but not even above their own 50-day moving average. And that speaks to some internal weakness. That speaks to the fact that not everything is rosy as the S&P itself at the high level is moving to new highs.
And that's really actually, I guess, a byproduct of the fact that the S&P is market cap weighted, which is that some of the largest companies like the FANG stocks have just such a huge weighting into the price trend that if you have more and more of the underpinning stocks that are the smaller ones going down, sometimes it's hard to reflect on the price when the big boys are continuing their advance. And this kind of gives you a really good inside inside look as to what's happening if they were almost all treated equally, rather than just by being market cap weighted that way. I love this one. This is actually that 50-day one on the S&P is probably one of my favorites that I watch on a regular basis. I'm glad you brought that one up. So what do you want to look at next in terms of breadth?
Yeah, the last one I would look at is what we call the bullish percent index, and this is maybe a little bit less familiar to some of your viewers, some of your listeners, but basically, point and figure charting is a classic way that traders would indicate trends, and it's literally was born on graph paper, on basically making X's and making a column of X's as the price was going up, and making a column of O's as the price was going down. I can actually show you an example of that here very quickly using the point and figure charts. Here we go. So this is a chart of IBM using what's called a point and figure chart. So you can see it looks very different than a traditional bar or candle chart that many of us are familiar with. This was actually designed as a way to get away from the noise of day-to-day movements in prices and actually focus just on the trend. So the x-axis, instead of being time, it's actually columns that are based on the trend. So if the market's in an uptrend, if the stock's in an uptrend, you're in a column of X's. When the stock starts to break down, you go to the next column and make a column of O's. And so what it does is it's literally just plotting the trend as opposed to plotting price over time. So a lot of times the bar chart on its own can actually get pretty noisy, especially during a volatile period or during a consolidation phase. These charts actually strip out the noise and focus purely on the trends. What happened recently with IBM, by the way, is it generated what's called a point and figure sell signal. And what that is when you have a trend that's positive. So you have columns of X's going higher and higher, and all of a sudden you have a column of O's, which is now a new downtrend, and the column of O's breaks below the previous column. So basically it's indicating a new swing low, a trend that's breaking below its previous support level. And it indicates some weakness in the price, the fact that the trend is really rotated from a bullish configuration to more of a bearish configuration. What a bullish percent index does is it basically looks at a bunch of charts in an index, like the 500 members of the S&P, and it says what percent of them are showing a buy signal on this point and figure chart versus a sell signal on the point and figure chart. So IBM right now would be registering a sell signal, so that would not be a check mark in the bullish percent index. That would be more of a negative sign. So looking at the bullish percent index, we can say, all right, out of the entire members of the S&P 500, what percent of them are currently in a buy signal? And right now it's around 66% here in early July. But overall, what you can see over time is in a healthy bull market phase, when the S&P is making new highs, you'd expect over 70% of the members to be in a buy signal, to have the bullish percent index above 70%. When it breaks below 70%, I think a key indication of that was here in January of 2021, when we had been in an uptrend. The market was making new highs, closing strong toward the end of the year. In January, all of a sudden that broke below the 70% line. That's what's called a bear alert, which basically means you're starting to show a lot of members of the index that are actually showing sell signals based on their trends. Their trends are actually starting to break down a little bit. That was one of the breadth indications that indicated to me in January and February that we're in more of a corrective phase, that we want to be a little more cautious and wait for the market to recoup or get out of that consolidation phase, which really didn't happen, in my opinion, until sort of late March and early April, when we again rotated back above 70% and demonstrated that there was renewed strength on some of the individual stocks that are comprising the S&P. If you look at the chart here in early July, you can see that while the S&P has been going higher, to your point about the cap-weighted indexes and the relatively narrow leadership of some of the FANG stocks, you see that the index, the breadth indicator is broken below 70%, which again is another warning sign, suggests that the breadth overall is not as supportive as it has been in previous months.
Well, one of the things that I appreciate about looking at the markets also this way is that generally, because stock markets appreciate, from bottom left to top right over time, and bull trends are more dominant. And of course, there's bear markets that emerge, but generally it's a upwards trending majority of the time. And one of the things that happens is that it's always hard to anchor where something is oversold or overbought on those uptrends. uptrends, but when you look at it, whether through a bullish percentage index or the percentage of stocks above or below their 50-day moving averages, it oscillates between that 0 to 100, and you can really see the cycles of overbought and oversold conditions much easier than just looking at the price chart alone. And it's always a nice complement to the way of approaching the markets, right?
Absolutely right. And again, I find things like breadth indicators and also, some sentiment indicators would probably be wrapped into this as well. It gives you color to understand, again, that sort of next level below what the index itself is doing. I think you're oversimplifying if you just look at a chart of the S&P 500 or the NASDAQ and think that that's it. Some of these breadth indicators can really help you understand what's actually driving the performance and recognizing what the leadership themes are when there's leadership rotations and where the opportunities might be, what the underlying strength is in some of these moves.
Right. And so when we had this conversation, so let's move on. So like when we had this conversation about your situational awareness and how you approach your macro strategy, I immediately said, Dave, we can't have this conversation without bringing in the dynamic yield curve chart that you guys have, which I think is just an amazing resource, because there are some really cool charts on a Bloomberg machine that costs you thousands of dollars a month. But the ability to go back and look at the shape of the yield curve the way that you guys have here is just such an amazing resource. So why don't you take us through this dynamic yield curve and how you utilize it?
It's a simple visualization, but such a beautiful one. And it really tells this story, the relationship between the yield curve and stocks, which is a common question that I get, I know, from our stock charts users and with my own firm, just trying to understand, especially now as we're thinking about the Fed in 2021 and, their potential policy changes here, through year end and into next year, and how that might impact stocks. Arguably, the most important thing you can do is look at the shape of the yield curve, especially if you want to understand why the financial sector is outperforming or underperforming at any given moment. It's essentially the shape of the yield curve that you're betting on, because that's really that speaks to the strength or weakness of their businesses. So what this is actually doing is, on the right side, it's showing the S&P 500 going back to really the market top in 2000, and then on the left side we're showing the Treasury yield curve. And a lot of people think about interest rates, very simply, which is fine. Look at the 10-year yield. For us, it's $TNX, which is basically just a tracking of the 10-year yield at any given moment. But the shape of the yield curve really shows the trajectory from the short end, the short-term notes, down to the long-term bonds, the 30-year bond at the end of there. And what happens with this yield curve is you can actually click on the chart of the S&P 500 on the right. You can look at a particular time, and as I'm starting at the 2009 low and starting forward, you can see how the yield curve is updating every month, and it's showing you the shape of the yield curve from short end to long end versus the S&P 500 on the right. And in general, a healthy yield curve has a nice upward slope. It shows you that banks are able to make money because they're borrowing at the short end and lending out at the long end, and overall, things are pretty healthy. But if you look back at some of these major tops, like in 2006 to 2007, you can see what's called an inverted yield curve, where the short end is actually above the long end. And you can see before a lot of the major tops, or around the major tops, you have that condition of an inverted yield curve, where the short end is above the long end. You can see where that pressure is alleviated, and all of a sudden, when the market's back in a normal uptrend, you can see more of a healthy uptrend in the yield curve. So overall, it's showing you this change in the interest rate policy, change in the shape of the curve, change in the short term to the long term rates, and not just looking at it as one point, but actually looking at the entire curve as well. And so now I think you really get to understand the shape of the yield curve versus what it looks like during historical tops and historical bottoms, what that means relative to where we're at right now. And now what we've seen is obviously historical low rates on the short end. We've seen a steeper yield curve over the last 6 months, which is what's allowed the financial sector to, perform very, very well. Now, as we have the prospect of the shorter end starting to come up a little bit, a flatter yield curve would certainly make it a little less ideal for the financial sector. And we're seeing the relative strength starting to suffer in the second quarter, going into the third quarter of the year.
Yeah, you know what I like as well is that trailer length feature underneath the yield curve, where you can actually look a little bit on where the yield curve was just, let's say, a month earlier, and you can really identify how it's dynamically changing. It's a really neat little feature, and it kind of gives you an idea of the direction that it's moving on that basis. I thought that was a really neat thing to touch on as well. Is there any other part of the macro strategy you want to cover, or should we get into sector rotation?
Yeah, I think we could get into sectors next. I mean, when I think about the big picture, for me, it's about price, breadth, and sentiment. We really hit on breadth, and I think part of that is also thinking about how equities relate to other asset classes. That's where the yield curve, looking at inflation, commodity prices are all sort of important. But then from there, when you think about an equity allocation, the question then is, where do you allocate within the equity space? And for me, when I'm looking at sectors, it always starts for me with the RRG, what's called the relative rotation graph. And what this basically does is this is designed by Julius de Kempener, who's who's been a friend for a number of years, and we actually used to follow his work many years ago when I was on the buy side, and he was at a broker in Europe, and he actually used to send us images of the RRG. He was just working it out and creating this visual, and we asked him to send us a snapshot every week. And we actually would create a PDF of all the weekly snapshots and then put it in motion, actually flip through the pages and look at how it did it. And he saw what we were doing. He's like, that's great. I really love to do that, to put it in motion and see how that evolves. And what's good is on platforms like StockTrek, you actually have the ability to put the rotation in motion. So instead of just seeing the static moments, how are all of these sectors related to the benchmark in the middle, you can actually, just like with the dynamic yield curve, you can actually press play and see over the last 6 months how these sectors literally are rotating around the benchmark in the middle. And if you're not familiar with this visualization, it's super simple but very powerful. Basically, it is sectors tend to move in a clockwise rotation around the benchmark in the middle. Further to the right means it's been outperforming over a look back period. Further to the left means it's been underperforming. And the y-axis is more of a second derivative, kind of a rate of change or a momentum of that. So higher means more improving momentum. Going down means weakening momentum. And overall, if all is normal, things tend to rotate in a clockwise direction around the benchmark. It doesn't always happen. There are plenty of changes that can occur, but overall, it gives you a sense of relative strength or weakness. And what it basically has told you, that if you're trying to get your head around this leadership rotation from the cyclicals, from energy and financials leading to things like industrials and materials participating, then the growth trade coming back, the RRG was just a beautiful way of visualizing that over the last 6 to 12 months.
Yeah, no, it's definitely. I love the way it's put into those quadrants, because it really tells that story of not only where the performance has been, but what is the natural rotation to occur. And one of the shortcomings that often occurs is that we have a tendency, human nature, to chase performance, and so those things that have worked best, we sometimes feel like we need to own them, and like suffering FOMO, we go and chase them. But when you look at a relative rotation graph, it really tells you there's a rotation that happens, and what was at one point the laggard inevitably cycles through, and there's going to be a period in the market where it starts improving or leading the market, and that rotation occurs. And this allows you to kind of visualize and map that journey and kind of give you context at where you are. If you're starting your buying and you're buying something that's up in the top right corner of the leading index, well, you have to ask yourself, how much of the easy money's rear view, and are you entering more at the 7th, 8th, or 9th innings of a game, rather than catching an early beginning of a key rotation where there's lots of upside in a market, right? And then that's what we do as analysts. We're always just checking on kind of always is there asymmetry in the trade? Is this a tactical time to be making that kind of a rotation? But just love the visualization you have here on this. It's certainly a great resource. And what is also a great resource on this is we were talking earlier about the bullish percentage index on the S&P 500. But what I really love is that we can look at the bullish percentage index on individual sectors within the market. And this really allows us to sort of see where each of those individual sectors are in that, from that breadth perspective in the individual sectors. And a really good example of that, like I don't know which one. Well, let's start with like financials. Let's look at the financial breadth. But what you have here is actually, I'll let you describe it. Why don't you take us through this?
Yeah, absolutely. So what this is basically doing, when you look at the table here, is it's showing you the broad benchmarks and then the individual sectors, and I'm basically sorting them by their bullish percent. So it is a quick way of ranking a group of things by their breadth indications. This is one of my favorite ways to do it. So basically, out of all of these measures, broad indexes and the major S&P sectors, what are the strongest breadth indications? Right now, it's real estate, it's telecom, which is like the old telecom sector, and it's information technology. The weakest breadth conditions right now are transportation, materials, gold miners, and then financials from the bottom. And what that's not telling you is that there are not pockets of opportunity within there. They absolutely are. Now, arguably, in every one of these universes, there are charts that are working and charts that are not. But this is more helping you understand the conditions for that entire group, right? How can I take the entire group of financial stocks, of gold miners, of healthcare names, and try to roll up their overall, breadth conditions? And by sorting them this way, you can immediately focus on sectors and areas of the market where there is internal strength, where there's strong breadth, where most of the point and figure charts are all in bullish territory, versus some of the negative ones, things that have been beaten down, and that there's more distributive properties in some of those individual stocks. All right, so let's look at particular at the financial sector. So, if you think about the chart of the XLF, or the chart of financials, that a lot of those stocks had really nice runs April into May, and that was sort of where things started to peter off. And charts like JP Morgan, Wells Fargo, and others have sort of come off since then. The bullish percent index over time actually shows that distribution, but in breadth form. So if you look, in early May, which is when a lot of these stocks were breaking out, almost 100% of the financial sector were in bullish trends according to the point and figure charts. Again, the X's and the O's that we talked about earlier in the show. Over the next month or two, it's gotten down to almost 50%, just above 50% of members of that index that are now still above, or still in a bullish trend. So that shows you the rotation from pretty much everything in the sector being in a bullish phase. And if you looked at the table, financials were the top ranked sector at that time in early May, based on their bullish percent indexes. You can see how that's rotated lower. It also shows you over time really the fluctuation of cycle, really from bullish and bearish cycles. You can see at the March 2020 low, literally 0% of the financial sector members were above their were in a bullish trend. They were all in a sell signal using the point and figure charts, and it shows you this cycle of recovery and pullback, of uptrend and downtrend, and really helps you focus on some of the sectors that have been leadership. And now it's real estate, which is a sector a lot of people like to not think about. It's sort of a forgotten sector. REITs, which are relatively boring at the moment, it's actually the strongest based on that methodology.
Now, one of the interesting observations that I always like to make is that when I intuitively, when a beginner looks at a chart like this, the first thing that you think of is that you buy when it hits above 90, or sorry, you sell when it gets above 90, and you buy when it's, let's say, below 50, and you kind of cycle through. But overall, I wouldn't necessarily immediately equate an overbought condition in a sector as an immediate reason to sell. It really, because when a whole bunch of the sector becomes in bull trend, those trends can often last many more weeks or months, and you're in a great sector that's running. But generally, if you're somewhat of a market timer, you want to buy dips. You want to buy a situation where a sector has already gone through a sell cycle, and a lot of times identifying when one of these sectors has been beaten down a little bit and things are cheap, it certainly is an interesting entry point for entertaining the idea that there could be a turn back up in a particular space. And I tend to generally try to curb my enthusiasm about chasing a sector once the bullish percentage index gets a little too high. And so it's like it just gives you a kind of a way to stress test a position. And what's really amazing, like you were showing on there, they have like almost every sector has it, including the gold miners and the energy sector and the technology sector. On here, you have a bullish percentage on every one of these subsectors, which allows you to really kind of scope in on your favorite areas of the market and see how that overall basket is doing, right?
It's absolutely right, and to your point on the financial sector, I always tell people when something becomes overbought, it's not necessarily a good or bad thing. I mean, it's more descriptive, right? I always tell people overbought means up a lot. That's not a bad thing that something's overbought. That just means it's been going up a while. When the bullish percent index gets very high, it tells me to start looking at the conditions underlying that sector. What's been driving that growth? And from a technical perspective, are you seeing any signs of trend exhaustion? As a trend follower, my goal is to identify trends, to follow those trends, and then anticipate when those trends are exhausted. And something like the bullish percent index can tell you when there's some short-term weakness, when there could be an opportunity to buy on the dips in a sector, and also the conditions that are similar to other market tops. And I would never make a decision alone based on the bullish percent index being higher or lower, but it would lead me to particular sectors to look for changes in trend and look for actionable movements on some of the groups and individual stocks in those sectors for sure.
I completely concur. So what I wanted to then kind of guide you toward after we looked at these bullish percentage indexes in this sector rotation is the seasonality, and there's a really neat feature here on the stock charts on actually looking at the seasonality over several years. So why don't you take us through this charting tool and how you use it?
Absolutely. So, the normal charts on stock charts are bringing up a bar chart or candle chart and then all the other, indicators and trend lines and all of that. But we also have a whole set of different chart types like point and figure charts. And as you mentioned, the seasonality charts. And, what this is trying to do is demonstrate the cyclical patterns that you see based on the calendar year, right? There's a sort of a natural trend. And one of the common things we hear of is sell in May and go away, which is basically thinking of the May to October period as being relatively weak, and then October through April as being relatively strong. And if you think about market history, that's kind of makes sense. Usually, you have a run into the spring, early summer doldrums. You tend to have weakness into the fall. A lot of the major market bottoms have happened in the fall, and then you recover into year end, and there's sort of this natural cycle to it. What the seasonality charts actually allow you to do is look at those trends for particular markets, for particular ETFs, industries, stocks, and actually understand it a little more often. So what this is actually doing is it's showing you the percent of times. I'm looking back over a 20-year period. I just have the XLF up because we were looking at the financials for the bullish percent index, and I'm actually showing what percent of the time that they finished positive every month, and it's aggregating, obviously taking the months going back over the last 20 years. So if you want to understand the seasonal changes and how that relates to what you're seeing currently, this is a really good way to visualize it. It's not just on the absolute prices as well. You can also put relative performance in here. So if I'm putting the SPY on the right side, now I'm actually looking at seasonal trends for the relative strength in financials. When I do that over the last 20 years, by the way, you can see, similar to what we sort of alluded to, we're kind of coming out of or sort of in the depths of the seasonally weakest part, looking at relative strength of financials. In general, the summer tends to be pretty poor for the financial sector, tends to improve going to the end of the year. So far what we've seen, which strength in the first quarter going into the second quarter, weakness in the middle of the year, and then if we would see potential strength there toward the end of the year, that would actually fit very nicely the seasonal trends that we've seen in the relative performance of financials going back for a couple decades.
Now, does this work on just indices, or can you do this on individual securities or commodities as well?
You could do it on anything. You could do it on ETFs. A lot of time, I mean, if you think about the ETF complex, there's pretty much an ETF for anything right now. So, I mean, it's a great way to understand just the trends in commodities, trends in broad markets, in relative movements and ratios. It brings in all the data pretty correctly. So it's a really interesting way. And again, the caution I would have is, I find people, if you over rely on seasonality and you think, okay, this is a seasonally weak time, I should sell this, I would say you're underselling your ability to understand the current market environment. For me, something like seasonality provides the headwinds or the tailwinds. It doesn't say that the stock or the ETF can't do well when it's a seasonally weaker time, and they can't do poorly during a seasonally stronger time, but it does give you the headwinds or the tailwinds. Is there a tailwind for performance or a headwind to performance? Meaning, is it, natural that this sector or that this stock or this asset tends to do well or not do well during a certain time of the year? And then that helps you understand the current environment, how that relates to the average performance over a period of time.
I completely agree, because in my mind, seasonality is an anchor, but you have to understand the underlying macro conditions and unfolding reality that's before us that is driving all the intermarket relationships that drive trends in all these different sectors. And you don't want to just go on the anchor of something like seasonality without having some context in terms of where the market is in its macro cycle. And so seasonality is a great, like you said, tailwind or headwind to different stages in the market, but one still has to have a bigger scope of the macro backdrop from which the current market is in. Is there something else you wanted to touch on sector rotation, or should we go on to security selection?
Yeah, let's finish it off. So the third piece, then, once you get your head around sort of the big picture, thinking about breadth and other asset classes, you think about sectors and where they're rotating, some of the seasonal trends. For me, at the end of the day, it's all about what lever you're actually going to pull. And the good news for investors is you have more ability now than ever at a relatively low cost to get exposure to a lot of different things. And again, the growth in ETFs and the lowering in price and commissions to access those markets is unprecedented. It's cheaper now than ever to actually get exposure to some of these different asset classes and global regions and individual stocks. So for me, it's all about how do you make sense of a virtually unlimited pool of things you could buy or sell in any given moment. How do you actually start to select things? So for me, this speaks a little bit more to the bottom-up process of trying to filter through what's happening and identify opportunities. So a couple of things I'll just suggest you to very quickly that I found to be very, very helpful. The first thing are what's called the scooter rankings, or the stock charts technical ranking. What we basically do is we have a quantitative model that was designed years ago, really driven by John Murphy, who's still our chief technical analyst, still cranking out research every week for our members. And again, has had a fantastic career. Most of us read the John Murphy book as one of our first books on technical analysis. And so a lot of stock charts was built with his inspiration or with his input to figure out how we should be presenting the markets visually. And the stock charts technical ranking was a way to try to take the things that John was using to understand stocks years ago and try to quantify that and systematize it to a degree. So what we do is we take a universe, and right now we're looking at large cap US stocks, but we have a bunch of different universes that we break out. So we have an entire universe just for ETFs, for the Dow industry group. So we break the US market into about 106 industry groups, and we have them all ranked based on their technical conditions. Then we have a separate universe for Toronto, for London, and for a universe in India. And what we do with each one of those universes is basically rank them separately based on their trend characteristics. You literally take a bunch of different inputs, a long-term, medium-term, and short-term weighting that are in those different pieces, and we basically calculate their trend strength from the 99.9th percentile down to the weakest trend based on those methodologies. And again, each one of these universes is independent. So if we look at ETFs, this is just looking at a universe of ETFs and ranking them in terms of their trend strength. This has been a fantastic way for me, certainly, to try to focus on what's working and what's not. If you want to see the strongest charts and the weakest charts, the strongest, the highest decile or the highest percentile of scooter rankings is going to show you the strongest trends. If we look at what we're seeing right now, it's things like natural gas, dry bulk shipping, some oil and gas ETFs that have had some nice jumps and overall in pretty good trend conditions. The weakest ETFs, not surprisingly, things like China, which have had a pretty difficult pullback. Things like the gold miners ETF, junior gold miners, which have had sort of been in pullback mode. What you can also do is actually look at how these scooter rankings have changed. So which out of this entire universe of ETFs or of individual stocks, which ones are seeing the biggest gain or uptrend or uptick or downtick in their scooter ranking in the last day, in the last week, or whatever time period we want to look at. So if we just look at the last day, the biggest weakeners are the ones that have lost the most in their scooter ranking are all cannabis ETFs for the most part. The alternative harvest ETF, MJ, THXC, which is the cannabis ETF, which ETFs have gained just on this particular moment, a bit of a mean reversion on some of the China ETFs that have bounced up. The online retail ETF, ONLN. This has been a fantastic way to just understand what's moving, what's the strongest and weakness over a longer term time frame, but also what's moving a lot over a 1 week period, over a 1 day period. And for me, it's been a fantastic way of just focusing on the actionable charts out of all the ones you could be focused on.
Right. And now can you then give us an example? Let's say go to like India or something like that under the reports. Does that go to individual security within the India ETF?
Oh, really good question. No, so we don't drill down. That's something I would love to for us to set up on here. We have a separate way of breaking down, particularly the sectors, and in particular the industries. And I didn't get a chance to show this earlier, but what I do often do when I'm looking at sectors and want to drill the next level down is use what's called the industry summary, and we can sort each sector based on their subgroups sorted by their scooter rankings. So within a particular sector, you can focus on the individual groups, strongest to weakness based on their scooter ranking, and then drill into the industry and get all the individual names that comprise those industry groups. We don't have that set up yet for ETFs, but to be announced at some point.
Well, that's still pretty effective to be able to do it this way. That's awesome. So let's now. There's also a way to look at the security selection in a gallery view, right?
Yeah, so gallery view is one of the I think hidden gems on stock charts. It's a simple visualization, but it's basically a way to say, let me look at a particular stock. So we're looking at electronic arts, and I'm looking at on a bunch of different time frames just in one view. So I'm looking at the intraday view, the daily view, the weekly view, and then the point and figure chart, and they're all kind of stacked together. And this was designed many moons ago just as a quick multiple time frame sort of analysis. What's the very short term, the medium term, the long term, and then the pure trend based on the point and figure chart. And you can understand how these different time frames are related to one another. But what you can also do is do a gallery view on two different securities, which is a great way to do a comparative analysis. So here I'm doing, let's say, electronic arts and PayPal, and now I'm actually charting the two of these side by side. So I have both of them on their intraday view. Now I'm looking at the two daily charts and how they're related, the two weekly charts and how they're related, and the point and figure charts and how they're related. So I'm cherry picking a pretty clear differentiation between electronic arts, which is a stock that had a fantastic run at the beginning of the year and then has really more been in consolidation mode, versus something like PayPal, which is also in consolidation mode, but is also starting to break out to the upside. And you can see the differences in the trend looking at the daily chart. You can see the differences in the momentum looking at the RSI, mid-range for electronic arts, overbought now for PayPal because it's had a nice run. The relative strength on the daily chart tells two very different stories. On a stock on the left, electronic arts, that's been essentially underperforming for much of the year, versus something like PayPal, which is really starting to see a nice rotation to the upside on the relative strength. So overall, I found when it gets down to it, on the institutional side, we would often have a group of stocks and have to compare and contrast. Should I be in stock A or stock B, ETF A or ETF B, industry A or industry B? And this is a really good way of just stacking up different securities side by side, doing a very powerful analysis relating their trends, their momentum, their relative strength profiles, and deciding which of those two you want to be allocated in. And I find a lot of times people focus too much on just one particular chart. You don't do enough about comparing them to something else you could be looking at right now. And often that'll help lead you into the things that you should be in and away from the things that are struggling.
Absolutely. So what I want to now do is ask you, just put you on the spot here for a moment and say, if you were only able to pick one indicator that you go to on a regular basis to look at a chart, which one's your go-to? This
was not part of our agreed on agenda.
It's all right.
This is unscheduled at the end, but I value the question. So I was quoted Walter Deemer, who's a longtime technical analyst here in the technical research team at Putnam Investments in the 1970s, and has been a mentor of mine, a fantastic encyclopedia of price and market history. He wrote a book a number of years ago on his technical approach, and he quoted me as saying, "I never look at a chart without relative strength on it." And that came from when we were in the Fidelity chart room, walking around and talking about the importance of relative strength, which is not focusing too much on just the individual stock's price movements, but how that stock relates to other stocks, and looking at relative strength relative to a benchmark, relative to a sector, relative to an industry can tell you a lot about the characteristics of a particular equity versus other equities you could be looking at. So I would have to say relative strength, because I find, especially individual investors, we pay too much attention on absolute returns and not enough on relative returns, where often that's where the real opportunity to outperform, that's telling you whether or not you're getting it done, is looking at the relative strength. So that would be my answer.
Well, there you go. That's a great answer. So what I wanted to do is just end the session with just a little bit of a higher level. Now, obviously, we're recording this a month or more before it's being aired, so we can't really talk about the stock markets from where they're exactly at. But I mean, we are now at the halfway mark of the year, and we had an extraordinary event with the COVID market crash, and an extraordinary rally on the other side that just took us to all-time new highs. What's your gut feeling on how the back half of the year plays out? What are you at least watching? I don't want you to make a forecast, but like
Sure.
with this kind of an event happening in the markets, what is it that's on your mind going into the second half of the year? What are you going to be watching, and what would not surprise you, but what would be your kind of base case as to what you think could happen?
Such a great question. So a couple things that come to mind. I mean, I think at a very big picture, when I'm looking at the market in 2021, I'm seeing a lot of similarities to the year 2010. And that comes from the 2009 and 2020 lows that were relatively similar. Conditions were different, totally fair, but both of those had a pretty severe market bottom in the first quarter. Both of them had a pretty quick V bottom with a lot of stocks that got very beaten down and then turned around and just performed beautifully coming out of the other side of that in the second quarter. And both of those years, the remainder of the year was actually very, very strong. So 2009 and 2020 were surprisingly resilient in terms of how strong they finished when you look at what happened in the first quarter. And so I think 2010 is sort of an interesting analog for 2021. 2010, if you know your market history, was it finished the year higher than it started, but there were some fits and starts. There were some higher highs and lower lows during that period. It was more of the digestion year. 2009 was the big rally. 2010 was where that was sort of processed and digested before 2011 and beyond sort of propelled the market into the 2013 highs and further. I think we're in a similar sort of environment at a very high level. The only difference we've had so far comparing those analogs in the first half of the year is that the market really hasn't gone down much, relative to what it did in 2010. In 2010, by now, you'd had a bit of a pullback. You'd had some sell-offs in there that were deeper than the quick rotations that we've seen so far year to date. So that's why I think as we're in the seasonally weakest part of the year going into the fall, that's what I would be looking at. I think, there's a potential for stocks to digest all these gains that we've had. We've arguably are seeing that in some of the cyclicals now in the midsummer months. And I wouldn't be surprised if the market overall, gives back some of the gains that it's had. And arguably that would set us up better than ever to see a strong finish into the year, which I would not be surprised for us to have. Other things I would be thinking about, Pat, would be number two, just the leadership rotation. You and I have talked a lot recently, and you very nicely came on my own show today on Stock Charts TV, which I appreciate. We talked about the breadth conditions, which are relatively weak relative to what they've been. We talked about the danger of the market going higher on weaker breadth readings. And I think by most measures that you look at, that's the condition that you see now mid-year, which again, doesn't tell me that the market can't go higher. It can dribble higher, which is what I would think we're doing right now. A small number of names are still able to push the market higher, but overall, it speaks to internal weakness. And so I think, again, we're setting up for a corrective phase that we haven't really experienced enough yet, I think, to justify materially higher prices coming later this year into next year. And then the final thing, to my long-winded answer to your question, would be interest rates. I think, the story of the next 6 to 12 months is going to be the Fed attempting to change its policy, attempting to recognize the economic growth that we've seen, the recovery from the coronavirus, assuming we continue to see improvements that we've seen in the U.S. and hopefully Canada and elsewhere. I think going into year end, it's going to be the Fed attempting to adjust their heading and attempting to taper back some of the very supportive, accommodative policy that they've had, and whether the market can digest that. I don't see the Fed being able to change what they're doing very much without the market getting very scared very quickly, because I think a lot of people are buying into the fact that the Fed is going to be a persistent bullish presence. If that starts to change, I think that'll weigh heavily on the market. So overall, I think those are three things I would certainly be focused on. I think the conditions could be challenging going into the third quarter, into the fourth quarter, and I would not be surprised to see us finish the year 2021 stronger.
Well, there you go. You heard it right from Dave. Now, Dave, I want to leave it with a question asking you to recommend a technical analysis book. But before I ask you the question, I do want to first give a plug because Stock Charts has a great chart school section where you can just learn about all sorts of these different indicators and the resources and tools, and it's free. And so you can go on there and get so much information. But if any of our listeners wanted to pick up a book on technical analysis, do you have a favorite that you would recommend to our listeners?
It pains me with many of my peers having written books to have to select one that I would recommend to everyone. So that's difficult to do. But if I had to pick one,
okay, let's not make it your favorite, but just one that our listeners, so that way you're not picking from mind.
Fair enough. Given how much we've been talking about breadth, I would recommend a book by Greg Morris called "Investing with the Trend." He does a great job. There are other books that, and again, I will cheat by mentioning others. The Dual Momentum Investing by Gary Antonoshi, the Ivy Portfolio by Meb Faber, and the Greg Morris Invest with the Trend, as I'm recommending. These are books that talk about the benefits of trend following. They talk about the benefits of a simple trend following model where you're focused on what's working and what's not. And all they do differently is different strategies to try to quantify it. I think Greg Morris does a really good job of talking about how to incorporate price and breadth and sentiment in a meaningful and consistent way. And while my process is not driven by a quantitative model as an output, I don't invest purely on a model. I do have models that are running in the background as part of a basic trend following approach. And I think Greg Morris does a great job of describing how that could work and how it fits into a discretionary stock picking exercise, which is how I try to think about it.
Well, Dave, I can't thank you enough for joining us. But before I let you go, if any of our listeners want to follow you on a regular basis and take advantage of a lot of these resources, where can they find you?
I appreciate it, Pat. And listen, congrats on Market Huddle. It's a fantastic podcast, which I enjoy listening to when I'm not on it. And congrats on what you guys have done. Congrats on your success. It's well deserved. For me, three things I'll mention very quickly. Stockcharts.com, as you mentioned, we have the chart school area, which if you're just starting to learn about some of the concepts we talked about, it's a free resource that a lot of people use to just understand the methodology, understand how to look at charts and how to make decisions based on technical input. So I'd encourage people to check that out. And you'll find my blog and my show called The Final Bar all in stockcharts.com and Stock Charts TV. Second thing, on Twitter at DKellerCMT, give me a follow there. And I always share free content from Stock Charts and elsewhere. And then finally, my YouTube channel is called Market Misbehavior. I try to pick apart different themes from a technical and behavioral perspective. So we're happy to have people join me there as well.
Well, Dave, thank you so much for taking the time to do this summer special for us so that Kevin and I can have some time off this summer. But anyway, thank you so much. I hope you enjoy the rest of your summer. And yeah, thank you very much for joining us.
I appreciate it, Pat. Cheers. Stay safe.
All right, thank you very much. That does it for this week's special episode, and we'll be back to our normal show format after Labor Day.
We hope all you huddlers have a great and wonderful summer. Patrick, where can they find you?
You can find me at bigpicturetrading.com or on Twitter at Patrick Ceresna. Kev, where can they find you?
On Twitter, I'm there at Kevin Muir, and you can check out my newsletter at themacrotourist.com. And listen, we can never have too many friends. Bear market, bull market, we're just happy to spend some time together on this crazy ride. So thanks for tuning in.